Hey guys, it's Eric Green. Listen, how do I make sure that all these potential clients sign my letter and pay me before we start doing work? I use Anchor. Anchor created a fully autonomous billing system and closes the cycle with zero errors. It sends our agreement to the potential client. We'll follow up with them automatically to make sure that agreement is signed. It alerts us when it gets read, when it's signed, and when payment is made. And this way, you know where you are every step of the way. I was so impressed with Anchor, which, by the way, is free. We went to Anchor and have partnered with them. Now, if you go and you register with Anchor, which is free, by the way, if I didn't mention that, you will get access to all of our checklists and letters, okay? But you have to go through our link, all right? Again, by the way, Anchor's free. There is a $5 fee per transaction if you're wondering how they make money. But given that our minimum retainer is $750, it's less than 1%. It's nothing, okay? So again, it's free. They charge the $5 transaction fee on payments, and it will automate your onboarding clients, make follow-up, just puts it on autopilot. It just saves you all that stress and you will close more deals. All right. So sign up here. It's www.sayanchor.com/tax-rep. Again, sayanchor.com, sayanchor.com/tax-rep, TAXREP. When you go through there, you'll sign up for free and you will have access to all of our letters and checklists, which will save you the trouble of recreating them yourself. All right. Go check out Anchor and put that closing process on autopilot. Guys, I've told my horror story before with S Corp clients and how do you know what reasonable comp is? My horror story is when they went after that CPA who was a friend of mine for $125,000, arguing that he knew and that he knew better and that he should have made sure his clients took reasonable comp. I'm a huge fan of RC reports. RC reports, it's about $1,400 a year. We're charging the S Corps that come to us under audit $750 a piece. We'll probably make between $10,000 and $20,000 with RC reports. But if you have S Corp or C Corp clients, they have to each year get a report, and the report is as simple as possible. RC Reports has a huge database of businesses. It will give you a report that you can rely on. And so far, to date, when we produce that report, not a single auditor has challenged it. The critical thing right now is for your clients to get that report to support the number they're taking on the return, that you're taking on that return that you're signing. Best way to do it, RC Reports. Go check it out, okay? You can find them. It's trn.rcreports.com. Again, trn.rcreports.com. Go there, you'll save $100. It will change your practice. We create an annuity stream for you and bulletproof your clients' corporate returns. The Tax Rep podcast is now proudly partnered with Nice Job, the experts in reputation marketing. Reviews are so important for attracting new clients. Before Nice Job, I would ask people to leave reviews, but they would usually forget, and I didn't have a way to stay on top and remember to follow up with them. That's where Nice Job comes in. Their smart follow-up campaign recognizes who hasn't left a review yet and automatically sends carefully timed reminders that can increase your chances of getting a review by 300%. I tried Nice Job for Tax Rep, and it's been a game changer. We added 33 five-star reviews in our first month, and our Google business profile is like a magnet for new customers. You can try Nice Job for free for 14 days and get 50% off your first 3 months by visiting nicejob.grsm.io/taxrep. nicejob.grsm.io/taxrep. I'm going to put a link in the description of the podcast. Try it. It will be a game changer for your business as well. How do I manage my tax rep practice? How do I get transcripts? How do I track what is going on with the IRS with every single one of my client cases? How do we complete the offer forms, the powers of attorney, everything? We use Tax Help software. Tax Help software is the cornerstone of our practice. We use it for its intelligent ordering. Every single night, it will update the transcripts on our clients, so we will see things happen long before those letters even go to the mail. We can then, react. We can let the client know. We can get all the transcripts we need to determine what our client's best options are, when is the debt going to expire, and we can fill in all of the IRS forms and get them filed accurately, the analysis done correctly. If you're interested in giving it a test, go to taxhelpsoftware.com, use promo code TaxRepTrial, all one word, all caps. You will get a free 2-week trial. Again, that's taxhelpsoftware.com, TaxRepTrial, all caps, for a free 2-week trial. If you love it and want to buy it, use TaxRep10, capital, all caps, TaxRep10, TaxRep10, all caps, one word. You'll save 10% on your purchase. It will be the engine that runs your tax rep practice, just like it's what we use for ours. All right. Afternoon, everyone. Thanks for joining us on this week's Tax Rep Network podcast. I'm Eric Green. Today, it's a fascinating topic. It's a hot topic and something that we're going to start seeing a lot of, which is the ERC credits, also insurance around this. This is going to be a focus of enforcement for the next 3 to 5 years at least. And we're now seeing this ramp up. And I've got two of the experts here with me. So joining me is Kenny Dettman from EZ-ERC, who we've done business with. And I have also with us Andrew Rubin, who is at Willis Towers and Watson. We'll call it WTW for short. And I really want to go through this in terms of what you guys are seeing, because one is you've been living in this space. We're starting to hear a lot of this from tax rep members who are now starting to see audits, and taxpayers come in, some that they actually worked on the credit. Some are now coming in who went to mills where we know there are problems. I find the question of insurance fascinating right now. And so with that, let me just give everyone a quick background. And then there's a whole bunch of stuff I really want to talk about. And by the way, everyone, I'll give you the link afterward. We're going to be doing a webinar on this. I know we're going to cover it briefly here in the podcast. On June 21st, there'll be a link in the description. Look for an email from us to register. It's a free webinar, and we're going to walk you through a lot of this stuff, because if you're not seeing it yet in your practice, you're going to. All right. So Kenny is the managing director with EZ-ERC, and Andrew is the director of tax insurance at WTW. We're going to be discussing ERC audits and related tax controversy issues surrounding it, as well as other COVID-19 related tax measures, including FFCRA. For those of you who are like, what the hell is that? Families First Coronavirus Response Act. Obviously, the ERC credits and Section 1202 deferrals. Additionally, Kenny and Andrew are going to be discussing the role of tax insurance in mitigating the risk associated with filing and claiming the ERC, as well as explain how tax insurance policies differ from a typical ERC provider's like E&O policy. And again, the insurance is a topic I started to hear about. And then Kenny, Andrew, when you brought it up, I think it's fascinating. And so with all of that, can you give the folks and just kind of an overview, how many ERC claims did you guys work on?
So to date, we have filed over 5,500 941Xs on behalf of roughly 2,500 clients. We are just shy of $1 billion in total submitted claims. Of those claims, we've seen about half of them process. So as you may know, the processing time for the IRS to actually issue the ERC checks, that can range anywhere from 3 to 12 months. Many of our clients are sort of sitting and waiting for that processing to happen.
Right. Well, and the IRS is trying to kind of weed out, what we're starting to see now what we're, given what I do for a living, we tend to see the worst of the worst. So we're getting calls, and they said, we went to, ERC scam mill, and they found that we haven't gotten the money yet. Now we have an auditor who's reached out to us. We went back to our CPA, and the CPA has now said, you got to go see a criminal attorney. Yep. Why? Well, I can tell you, I think they realize you got a problem. So what are you seeing? Because you're a CPA. I know your organization. You've been vetting this before it goes out. What are you having other people come to you now who went elsewhere looking for help?
Yes, absolutely. What we're seeing with respect to what the IRS has dubbed, these ERC mills, is that if you really drill down into their engagement letters that they have with their clients, there's sort of one of two versions of that engagement letter, one of which is basically putting the client in a position where not only in signing the engagement letter are they taking on responsibility themselves of assessing and evaluating eligibility. Later in the process, the ERC mill is often putting an attestation form in front of the client, reiterating the fact that, I, client, am attesting to have met one of the two eligibility tests. And what, of course, is going to happen if it all blows up? Client's going to be pointing the finger at ERC mill. You didn't do your job. You didn't help me understand, evaluate my eligibility. And ERC provider is going to point back to client and say, no, you signed here that you said you met the revenue test or the partial suspension test. And then you reiterated it here on this attestation form. That's sort of version one. Version two of the engagement letter is where the ERC mill is really nothing but a broker, a middleman. You sign up with XYZ ERC mill. And next thing you know, you're being introduced to Joe Schmo CPA, single partner in St. Louis, Missouri, and that's your service provider. And there's provisions within the engagement letter that says that XYZ ERC mill is not responsible and not liable. They are relying on the third-party services of Joe Schmo CPA. Neither of those results or those structures are certainly favorable to the client signing up. And of course, when that auditor comes knocking and client goes to their income tax CPA and says, what am I going to do about it? CPA says, well, show us your eligibility analysis or eligibility report, whatever the nomenclature is. And they show, either nothing, because they signed and said that we're eligible, and usually that's established based on these. If you look at some of the marketing, these mills are saying we'll qualify you in 8 minutes or less. Some go up to 15 minutes. Basically, a phone call is taking place. That phone call is the totality of the basis for establishing eligibility. There is no substantiation documentation provided as part of the final deliverable. So that client's totally SOL if they're trying to respond to an IDR. The other possibility is that, sure, the mill has done some work in terms of providing a substantiation package. Usually what we're seeing there is very, very, very boilerplate. Bury the report with CDC and OSHA orders, something that just simply not going to hold up if looked at closely under an examination.
Right. No, and listen, folks, because we see this a lot in just the normal criminal arena. Taxpayers will come to us. I relied on, and mm-hmm. You have to remind them you're responsible ultimately for the return. It's always good to put the fear of God into them a little bit, saying, look, I understand you had a bad preparer, phony deductions, but how did you not know? Don't laugh. We've had this. How did you not know that you didn't have a side nursing business that lost $50,000? And they look at you kind of blankly and say, look, I understand you're blaming them, but criminal is going to have a very obvious question. Like, how did you not know? Now,
Yeah,
by the way, I had a situation once as an aside. Client said, and what actually came out, they were given one return. And after they walked out the door, the preparer went and created all kinds of phony C's and everything, jacked up the deduction. And on the 8888, let's say it had been $1,000, so they were going to get $250, and the client was getting $750, which is the splitting of the refund. That's how some preparers get paid.
Yep.
Instead, now it's a $5,000 refund. Client still gets $750. The preparer took the rest. But that's uncommon. Usually, they're claiming they're blaming the preparer, and the preparer, IRS would say, "Why didn't you know this?" Here, what you're going to have, I believe, or what we have is taxpayers who are going to claim I relied on, but meanwhile they signed documents that said you're attesting to.
Yeah,
and that's going to get interesting from a criminal perspective. Civilly, very simple. You owe the money back, with interest and penalties. And so I'm wondering if there are some businesses that did this to try to save themselves and may end up being destroyed in the end anyway, because I think there are a lot of people paying this stuff back.
Yeah, the IRS has now, I think it was last week or the prior week, has released their fourth warning. And it's generally understood, as these warnings have evolved, the IRS is trying to sort of create awareness of exactly that you, taxpayer, employer, are ultimately responsible. Here are some warning signs to look at as to what might constitute an ERC mill. Now we've told you sort of 3 or 4 times what this looks like. You're in an examination and you have an unfavorable adjustment of the examination, and you try to point the finger. The IRS is trying to build the ammunition to say it was your responsibility, not only to at least understand somewhat the position that you were relying on for the purpose of eligibility, but within the reasonable cost standards, right? You still have the onus to make sure that you are working with a professional, a provider that has the requisite credentials to be providing the service that you're requesting. So when you have this cottage industry, and it's probably greater than a cottage industry now, of ERC mills, which are substantially staffed, overwhelmingly staffed with non-tax professionals who have never been in this world at all in life. I was at a seminar a few weeks ago. Glenn Frost, who's an attorney and has been doing ERC work, and he's been doing great ERC work. His firm was saying, was using the expression, you've got folks out there who are swinging a hammer on a Tuesday, and on Thursday they're out there processing ERC credits. And so trying to use a reasonable cause argument to say, well, we were relying on who we perceive to be a reputable, credentialed provider capable of providing these services, is likely not going to hold up the way many of these employers or taxpayers might think it will.
Well, and here's the interesting thing. So you've got the criminal aspect, right? And maybe if you could show that you relied, or at least straight face, you relied on them. Okay, maybe it's not criminal. Maybe you can get out of the penalty for reliance. You still owe the tax back, right? Yep. You're still going to owe the interest. So it's not like if I can show I relied on them, they misled me, I'm a victim.
Yeah,
that's great. Maybe we can, you can file for penalty abatement and criminal will go away. But here's your bill.
One more expense in there, Eric, which is many of these ERC mills are charging 25, we've heard 35% of the credit, and taxpayer receives their $100,000 credit and pays ERC mill $25,000 to $35,000. There's a very low chance that is going to be returned, in your 3 to 5 years from now, when the IRS is looking at that file and making an unfavorable adjustment. So it could be a very costly mistake.
Oh yeah, and it would listen. The same rule all the time: buyer beware, right? Mm-hmm. I mean, you're talking about swinging a hammer here. Our big thing is they're a travel agent in an immigrant community for 9 months out of the year, and then they become a tax prep place using TurboTax. So people are doing self-prepared returns
Right.
from February to April 15th. And I'm saying, you knew they were a travel agent? Why would you, whatever? So listen, go on.
Well, a lot of it has to do with the marketing spend, right? You generally associate, significant marketing spend with sort of success in an industry, and success in an industry should translate to competency in the industry. So the guys you see advertising on TV, radio, where sending notices that say they're coming from the Department of the Employee Retention Credit is confusing consumers, is confusing taxpayers. Think, well, these guys are spending so much money, they must be good at what they do. It kind of reminds me of, I don't know what the equivalent in the Northeast is, but down in South Florida, we have a lot of advertising for a company called 411 Payne. And 411 Payne is not an attorney; it's an attorney referral service. But they go, bonkers on advertising. Using 411 Payne does not mean you're going to end up, using a high caliber, high competency attorney to deal with your personal injury issues, and in this case, using a large advertiser for your employee retention credit.
Right. So listen, the IDRs that are coming in for the ERC, can you walk us through? So what do those look like?
Mm-hmm. So they've been fairly consistent from inception, and inception is, maybe a year and a half ago when we saw the first iteration. The IDRs are almost, the equivalent of the 8 bullet points that the IRS laid out in Notice 2021-20, which was the first of the 3 notices that the IRS released. And in that notice, they said, here's what you need to substantiate an ERC claim. And sure enough, that's exactly what the initial version of the IDR was asking for. No surprises, which is, that's sort of the way it should be. The main thing we've seen evolve is around this concept of a partial suspension, which is likely the source of the most abuse. Initially, the first version of the IDR was just asking for copies of the governmental orders that were being relied on to claim a partial suspension, which was kind of wild. You're just gonna, and that doesn't mean it's the end of the story either, right? So, but provide us the governmental orders. And, some ways we thought, okay, maybe we're done after that, because we built out a window of when executive order restrictions, existed, for example, in the state of California from late March of 2020 through June 15th of 2021. Taxpayers, employers good in that period. Well, the IRS evolved, the IDR evolved, and now what's the IRS asking for? They're asking for proof that if you relied on these 2 subtests within partial suspension, one to establish that a portion of your business was more than nominal and affected, or the other to establish that either the business as a whole or that nominal portion of the business was more than nominally affected by those governmental orders. Now the IRS is asking, prove that as well. Taking it one step further, you have executive orders, you have clients saying, we made changes, we were subject to restrictions and modifications, and that's written up in, an EZ-ERC or, XYZ ERC Mills eligibility report. The IRS is taking it one step further and saying, show us proof that you actually instituted those changes. And that can be challenging for small taxpayer, small to medium-sized taxpayers whose record keeping isn't great. What are we hearing works there? Copies of policies that were live during, during COVID and post-COVID, email correspondence going out to the organization saying you need to do X, Y, and Z. But substantiation is incredibly important. Going back to choosing a service provider for the employer retention credit, ask them for an example of, a prior report they've done to understand, well, what degree of effort are they putting in to making sure that if we end up with this IDR, that we can be completely responsive to it just based on the work that provider's done. So the IDR has not changed much. The only meaningful change we've seen is with respect to partial suspension. Of course, they're asking for all the usual suspects on payroll. They're going to ask for your gross wage reports. They're going to ask for proof of employer paid health. They're going to ask questions to try to understand potential aggregation concerns. And then they're going to ask about some of these other things that you mentioned. FFCRA credits interact with the ERC. 1202 deferrals interact with the ERC. Most notably, the PPP very much interacts with the ERC.
Right. And one of the questions I was going to ask is, in terms of the ask, how do you substantiate? And I think you kind of hit on a lot of that. So if you were partially suspended, emails out to all the employees, the payroll reports, obviously, potentially, I guess, unemployment claims for people that got let go. I'm trying to think of.
So let's break it down sort of in those three categories of governmental order. Well, that's easy to understand. What we've anecdotally heard doesn't work, that was kind of suggested early on, is just throw the book at them, throw them, all the California state orders and say, here, you figure it out. The IRS says, no. You're going to highlight the sections of that executive order that you are relying on that led to those restrictions and modifications that you're relying on. The second piece, more than nominal portion allows you to claim an ERC based on a suspension of a part of your business that represents more than 10% of revenues or 10% of service hours, looking back to 2019 as a testing period. So that can be proven out very objectively with financial data. More than nominal effect is a little bit different. What the IRS is asking us to prove out there is that due to the restrictions and modifications under governmental order, there was a more than nominal effect on the ability, and that's the probably the most important and the most challenging word that's within the notice as it relates to partial suspension, is affecting the ability of an employer to provide goods or services. And it is an absolutely nebulous, confusing process for most businesses on how do we measure the ability. We can measure the output. We can look at revenues. We can look at KPIs. I'll give you an example, a medical practice, right? We're looking at potentially reduction in patient volumes, but that's a measure of the output. What the IRS is asking us to measure is the effect on the ability to obviously serve patients. So reduction in patient volume is good corroborating evidence that something was happening related to the ability, but there's always a demand element in there too. So that is the most challenging part, is how do we not just measure the output, but also the ability? A lot of times that's just really detailed qualitative descriptions of what did we do. We shut down our waiting room, for example. We spaced out our appointment by an extra 10, 15 minutes. Well, wait a sec. Now we have sort of a quantitative measure of if we were doing, 3 appointments per hour and now we're only doing 2, then we've reduced our ability to service patients by 33%. So that's where the real art comes in. And then the final step of, all right, we actually have to prove that our waiting room was closed, or that we were, turning over rooms at 10, 15 minutes apart of greater time length. That is probably the most challenging to obtain. KPIs, sometimes more challenging than not, but it's sort of those 3 pieces that you've got to put together. Interestingly enough, the sort of process we developed wasn't based on our experience with IRS IDRs. It was based on Andrew, Willis Towers Watson, other tax insurers basically putting us through underwriting And that underwriting was sort of predictive of where the IRS was going to go in terms of asking for substantiation. So they were sort of one step ahead, and they were very accurate in the way they were asking for this. It's the same way logically the IRS is asking for it.
Yeah, no, we'll get to that. But in terms of the big exposure areas, is it an inability to document this stuff? I mean, that you shut down your waiting room, because it's one thing although again, you could from an email, perhaps it went out to all your patients, right? That, we've shut down the waiting room. Please stagger yourself. My daughter just started her summer internship at a very large company. They take like 5,000 interns across the globe. So when they had people coming in, they literally said, "We've staggered you. Do not show up early."
Yep.
And so I mean, that kind of messaging. But in terms of people coming in, where are you finding are the issues? For instance, I'm listening to clients. What should I be telling the client? Like, look, you got to we got to get going on this, because if we haven't heard from the government, we probably will.
Yeah. So there are three categories of somewhat subjective technical issues within the ERC where we see abuse. One is partial suspension. We've already discussed it. The other is aggregation. Which, your tax professionals out there know 52A, 52B, and 414, sort of the equivalent of PPP's affiliation. 414 can be a highly subjective code section in terms of determining aggregation. You have regs released in 1980 that were subsequently withdrawn, that we're sort of still relying on. There's no case law on it. So aggregation, in particular affiliated services groups and management organizations, that's not that common, but there's certainly abuse or turning a blind eye there. There used to be one of the largest ERC providers in the country used to have an engagement letter that you'd sign, and they'd let you check a box that said opt out of aggregation. How do you think that's going to go on examination? And then the third category is M&A over the life of the ERC. The IRS released a 102-page notice in March of 2021. They released 2 more notices. They just couldn't capture every fact pattern. So there's a lot of sort of weird results when there's acquisitions and mergers and divestitures over the life of the ERC. So those are the 3 complicated areas. And then there's the not so complicated areas of like 52A, 52B aggregation. Like those are quantitative tests. Determining a related party. Well, if you're leaving an in-law off, you're just not reading the rules. Interacting PPP and ERC wages, if you're not doing that, you're just working with a bad provider. So those are kind of the easier ones to knock off. It's the 3 subjective areas that I think it's to be determined in many ways. How strict the IRS is going to be on partial suspension. We have heard of Dan Choden out there is probably the number one. He's good friends with Randy Crabtree. We often go to Dan to ask for some advice on ERC matters. He recently tweeted about and I don't think it was his case, but an ERC eligibility position on partial suspension, white collar. It wasn't real specific, but sounded like it was probably some type of consulting or technology or law firm, white collar. Everyone, went home to work from home, and the IRS concluded you did not have a partial suspension. One of the overarching themes of partial suspension is that to the extent that you're able to replicate services from a telework platform in a reasonably equivalent manner, it does not rise to the level of a partial suspension. So I think the IRS is going to be out there trying to take wins like that. We hear a lot of, we couldn't meet people in person and it just didn't feel the same. Not a good argument. We couldn't, we attended a trade show once a year and we couldn't go to that trade show. Probably not a good argument. And then there's the supply chain and OSHA CDC, which is the source of the most abuse. That one, you could spend a whole podcast with Randy, and I think there have been some, Randy and Dan, and they'll tell you all about what the abuse that's happening in the supply chain argument.
And so, in terms of the fraud,
Yeah.
And we were talking about this before we started the program. You've got the blatant fraud, right? Which is, I didn't even have employees, right? Just gonna file. And the IRS is trying to catch those before the money goes out the door.
Yeah.
But then you have, like you said, this partial suspension. Where do you think the government's going to be focusing its fraud efforts?
Real fraud, or I hesitate to. So you've got the black and white fraud, and then you've got the gross abuse of partial suspension. Is that what you're referring to there?
Yeah, right.
Yeah. So, to some extent, the IRS, I believe it was the IRS, in Notice 2021-20, this was not in the statute. The IRS defined partial suspension as a facts and circumstances based test, which in hindsight, they might have removed facts and circumstances and tried to just create some, quantitative tests that needed to be met in order to meet partial suspension. They did complement facts and circumstances with quantitative tests. We often call these safe harbors, but they're not, they're sort of not exactly the way we normally understand safe harbors. But those two safe harbor tests are the more than nominal portion test, 10% of revenues or service hours, to be able to look at a subset of your organization and find a partial suspension. And then there's the more than nominal effect test, which we spoke about. The IRS did say that to the extent the restrictions and modifications, so in the doctor's office, the things I mentioned, waiting room, enhanced sanitation and hygiene, to the extent the restrictions and modifications affect the ability of the organization or the portion of the organization to provide goods or services, to the extent that effect is greater than 10%, then you meet this objective safe harbor. What's the challenge there? Is that in portion, the IRS said measure revenue or service hours. In establishing the effect, the IRS asked us to measure the ability. They did not say revenue. They did not say, units of output. They did not say widgets produced. They said measure the ability by 10%. So it's sort of a flawed safe harbor in that. How do you measure? So where do I think the IRS is going to draw a hard line? They're going to draw a hard line when you had businesses that continued to operate, pivoted to a telework platform, and it's very, the taxpayer's not able to establish that it wasn't reasonably equivalent. Even in schools, we're hearing about virtual learning. There are certainly many providers out there, including us. We do sometimes work with schools under unique circumstances. A school trying to make an argument that moving from in classroom to virtual classroom might be a good argument, but it's probably not a great argument when you're dealing with, call it, 3rd grade to 12th grade. It's a good argument when you're dealing with pre-kindergarten, kindergarten, 1st grade. If you're dealing with the mentally challenged students, if you're dealing telehealth with elderly or the or potentially disadvantaged classes of employees, it might be a different story. So hardline, where there's just no ability to say that it's not a reasonably equivalent service from a telehealth platform, and they're going to draw a hard line. I don't think that they're going to take just sort of generalized facts and circumstances based arguments. They're going to want to at least see an effort that you've tried to prove out these safe harbors. And if those don't exist, or if there's no documentation at all, it's going to lead to a proposed adjustment.
And on that note, I want to get into the insurance issue, which I find fascinating. But on that note, are there non-IRS resources? So if I'm listening to this and I want my clients to start documenting and trying to pull together substantiation, are there resources that people can look at beyond the IRS guidance?
So I'm biased, but I think our firm has produced probably the best practical guide out there on what is needed in terms of meeting the substantiation requirements. I mean, this guide is basically looking at what was in the notice, what are we seeing on the IDR, and what are the actual documents, what are the actual quantitative and qualitative materials that would be in practice used to substantiate and to meet these requests. What we have from the IRS is you have Notice 2021-20, -23, -49, all very generalized. The IRS came out with their own training manual that they gave to their examiners. That training manual was really just a compilation of those 3 notices, so sort of nothing new. And then they later came out with, I think it's 800 to 900 slides that they use to train their auditors. Again, really nothing new. So there's not really anything out there from the IRS that says that if you want to prove your full-time employee count, you need a schedule of your employee hours by month in 2019 to substantiate how you met you were under 100 or 500 full-time employees. So that's probably a good example right there, is that the IRS says that you need to provide evidence that you were under 100 or 500 full-time employees under Section 49080H in 2019. There's nothing in the IRS notices, there's nothing in these training manuals, even to telling their examiners, here's how practically you would determine that. So what we've created is, what are we asking our clients to provide to us to make sure they're under 100 or 500? The first place to look is the Affordable Care Act actually uses the same code section as the Employee Retention Credit to establish full-time versus full-time employee equivalent versus non-full-time. So that's the first place we look, is a 1094C. Okay, a 1094C shows us that we're at 95 full-time employees. Well, we're a little bit too close for comfort here. We're going to ask for an Excel export from your payroll software that shows us how that was calculated. So what the practical guide is saying is, if the IRS is going to ask you for this, be prepared and already have these items on standby. So if you go to our website and go to our knowledge center, you'd be able to find this practical guide for navigating an ERC audit. I really haven't seen anything else out there like it. I'm pretty proud of it. We put a ton of effort into it. So hopefully your members can use that as a resource for at least a starting place on how would we actually practically respond to these IDR requests.
And it's the practical guide to navigating an employee retention credit audit. By the way, for those listening, there's a ton of information out on Ken's website. Not just this guide, but articles, the IRS release information. There's a ton there to dive into. And I hope people do. But no, the practical guide to navigating an employee retention credit audit is there. Folks can go get that. And I think that would be very helpful. I will put I'll put a link in the description. So go check out the information that Ken and his folks have provided. There's a lot of good stuff there. And so, with that, Andrew, when I first started hearing about the insurance thing, I was fascinated by it. So if you don't mind explaining, I think we all understand the concept of insurance, but how does this insurance work?
Sure. And thanks, Eric, for hosting, and Kenny for inviting me today. Pleasure to be here. So tax insurance, I'll give a brief overview and then we can kind of delve in a little bit on how what we've seen on the ERC front. So tax insurance overall is meant to protect the taxpayer in the event of an IRS audit against financial downside. And what does financial downside include? And Eric, you were kind of touching on this before when you were talking about the IRS is going to give you a bill not only for the tax, which is the reclamation of the credits, but also for interest, penalties, and you're going to have to expend your own costs. So the tax insurance policy is fulsome. It will cover any taxes due or any credits due back to the IRS, any interest that accrues on those credits, any penalties related to the credits. It'll even pay for contest costs, because if you get audited, and Kenny touched on a lot of subjectivities, there may be a fight with the IRS. It'll cover that as well. and it will cover what we call a tax gross up, which essentially means if you do get paid out from the policy, those proceeds may be taxable to you as a taxpayer. The policy will pay the taxes on those. So in the end, the tax insurance policy really makes a taxpayer whole in the event of an IRS audit or challenge.
What's the timing of this? So for instance, like normally, do you have to have the insurance prior to filing the claim, prior to an audit happening? I mean, when if I'm listening to this thinking, this sounds like a pretty good idea. When is the time? What is the timing for when people should get the insurance or can get the insurance?
Optimally, we would place it at the time the claim is filed with the IRS. So when you send those 941Xs in, that's when you would also bind the insurance policy. And the reason we like to do it there is because the insurance policy will pay out in the event the claim is denied by the IRS. So you file the claim, let's say 3-4 weeks later, they deny it, the insurance will kick in. Or B, you file the claim, you get the refund back. 3 years later, the IRS comes knocking and says, you're under audit. We're taking a closer look at this. You can also make a claim then. But if you've already filed your claim and you've received the refund or you're awaiting to receive the refund, you can still place the tax insurance policy and it'll still kick in the event the claim is denied or if you receive the funds in the event of an audit. The final step or the final time when you can place the tax insurance is when you've already been audited. So this is the akin to a car crash scenario. You usually can't get auto insurance once you've been in a car crash, but in the event of tax insurance, there is still an opportunity to obtain tax insurance in the event that you are under audit. Now, it will be more expensive, it'll be more difficult, but it is still possible.
Interesting. And to start the process in terms of, before we even get into that, what kind of information do we need to provide? I mean, probably a copy of what we're submitting, right? I assume the 941X is whatever. What else does the company ask for? Like, for instance, I would imagine there'd be some sort of an audit, right? In other words, the same information that Ken's saying, hey, you should gather in case of an audit. Does the insurance company want that to kind of vet the quality of the claim?
Exactly. So if you think about kind of the parties at play here, we have the taxpayer who's making the claim on the credit, and we have the insurance company, which is basically stepping into the shoes of the taxpayer with respect to this claim. So the taxpayer gets to enjoy the claim, gets to use the money in its business. But at the end of the day, if there's the IRS comes knocking and reclaims that credit, the insurance company is going to pay. So the insurance company within its file is going to build the same audit file that the company would build to defend itself. Now, when the IRS does come knocking and has an audit, the company will be defending itself and using its counsel to defend that audit, but the insurance company is paying the bill at the end of the day. So they're going to pay for the defense costs. They're going to pay the final tax bill, including interest and penalties. And they're going to make sure that everything is buttoned up going into this whole process to ensure if there is an audit, their file is complete, just as a taxpayer's file would be complete. So to get started, normally all we need is, and this is assuming the insurance is meant for firms that have done or have used a reputable firm. It's not meant to cover fraud. That's actually in a specific exclusion. These are meant for companies that, have a reputable firm like EZ-ERC, are still worried about there's, limited guidance out there. There's no case law. There's a lot of subjectivity, as Kenny mentioned, on some of these tests and what goes into them. If they were quantitative, we wouldn't be living in this gray area of ERC claims, but unfortunately we are. And that's where the insurance kind of comes in. The insurance will say, you're worried about this gray area. You have a good claim. You have the documentation behind you. An insurance company is going to look at all this documentation and say, we agree that we feel like you have a good case here, even upon audit. And they'll then decide, okay, we're going to put up terms and this is how much it will cost to transfer your risk of financial downside to an insurance company.
Andrew, I think it'd be helpful because, you mentioned it's kind of a prerequisite to work with a reputable firm, but we certainly get folks coming to us that had worked with a non-reputable firm. I guess I would conclude that it's not impossible for them to get tax insurance, but typically what we're seeing from the tax insurers is that they kind of require a new firm to come in, or maybe in a limited case, the client to fill the gaps that were left behind by the ERC mill. Is that fair to say?
That's fair to say. And what we've done now is we've had those people come to us where it's been a limited analysis on the first go round. I had one recently where it was just kind of laid out the orders and very limited analysis of the orders being applied to the business. And that's where we see the biggest gap right now. And I think your firm, Kenny, does a great job of this after reviewing and vetting your process quite a bit, is companies sometimes have trouble. Okay, we know everyone knows what the orders are, but how do those orders actually apply to your business that cause that more than nominal effect? And that can be quantified with KPIs or written up in a coherent way by EZ-ERC. And now, Kenny, what we're hearing from the IRS is that's what they're really digging in on.
Yeah.
They're asking companies to have that analysis ready to go. So if you have that analysis ready to go, and even if you don't, you can still come to us and we'll work with you. And that's kind of what makes a good broker. We know what the insurance market's like right now and what they don't like. So to get the best pricing and even to generate terms overall, you come to us. We know the marketplace for these, and then we can guide you through the insurance process.
Kenny, because I know you did. As we went through the numbers, the ton of work that you did filing, are you finding you're doing a lot of this sort of what I'll call cleanup work? People that have these gaps that are coming to you to try to fill them in now?
We have those opportunities that present themselves. I can tell you that what happens for the vast majority of them is clients work with XYZ ERC mill. They've made a claim through Q3 2021, which is the maximum claim you can make. They send us materials that say that they relied on a supply chain argument plus OSHA plus CDC. And we have to tell the client or the prospect, if you do choose to work with us, there's a very strong possibility that we're going to have to dial back your credit. And in most cases, they end up going elsewhere. Yeah. I thought it would be helpful, Andrew. We're really focusing on this concept of partial suspension. We have an entire team that's all they do is partial suspension, but it took a long time for us to kind of develop a streamlined process. So for your listeners, Eric, I can already give you a preview of what the insurance markets expect on it's basically a 4-prong or 4-step process that we actually developed during our first underwriting. We work with a large A-rated insurer. They underwrote a $12 million claim, and they asked us to first establish whether we're looking at the business as a whole or a portion of the business to evaluate partial suspension. Second, they asked us to build out a window of eligibility order coverage and identify where within the orders the restrictions and modifications are sort of arising from. 3, they asked us to identify the specific restrictions in the business or the portion that were restricted or modified by virtue of those executive orders. And then the 4th step is quantification. How can we, from a quantitative perspective, demonstrate that a 10% metric in some way has been met that can be tagged to kind of the ability and the output? So if you follow those 4 steps and you do them well, there's a very high degree of likelihood that you'll be a candidate for tax insurance, barring there are some minimum thresholds that Andrew would talk through as well.
Yeah, and that's a really good point, Kenny. So we've worked with EZ-ERC and put them through the rigmarole of the vetting process, including with the insurer and their counsel as well. So their firm has been thoroughly vetted. And what we can now offer is this streamlined insurance solution through EZ-ERC and an A or an A+ rated insurer. What that includes is, usually pricing in the 5 to 10% range of the ERC claim. So if you have let's call it $10 million ERC claim, it might cost you between $500 to $1 million to insure that claim fully. If you are worried about an audit and you think there's a less than 5 or 10% chance of winning, then or of losing, I should say, then the insurance may make sense for you. To go through the process, Kenny, and kind of we've vetted it so thoroughly that as long as you have worked with EZ-ERC and we've spoken to Kenny about the qualification criteria, there is a good chance that you could qualify for insurance as well. And that's kind of what we're bringing to the table to make it as easy and simplified as possible.
And if you haven't worked with us, I mean, it's fair to say that today the insurance markets are entertaining claims at $2.5 million. Is that?
Yeah, I'd say $2.5 to $3 million of a minimum claim is where they're entertaining it. And that's just a factor of tax insurance is a relatively bespoke industry. And there are, you know, costs that go into it, including the underwriters hiring their own counsel. So when you put the cost together, you know, minimum spend from a taxpayer is in that $200,000 to $250,000 range if you're not going through the EZ-ERC program. But so that $250,000 spend, you know, minimum coverage, we'd probably look at $2.5 to $3 million.
And if you run through our program, the minimum is typically $500,000 for a claim.
That's correct.
Now, guys, it's fascinating. We are going to be doing a webinar again on June 21st. I'll put the link down below in the description, and also an email will go out. I think we are going to have a full house for that, because this is a hot topic. It's only getting hotter. And it's an opportunity for people, everything from defending the claim to people who should not have gotten the money, helping them sort out the repayment, all of that kind of stuff. There's going to be a lot of work.
Some discussion, Eric, on a voluntary disclosure we don't think it's going to happen, but that's out there.
I've heard the same.
Yeah.
I'm not sure, but you know what? I will tell you, it would make sense. And you know what? From the government's perspective, here's why it makes sense. It would make sense for all the people in the gray, because the IRS, I know we all talk about the funding, and it's going to take a long time to get auditors hired, trained, and get them out. So the outright fraud stuff, that's easy. It's all of the gray. And if you could knock out even 10 or 15%, say, you know what, come in, we'll waive the penalty, we'll give you, whatever. If you could get a handful to just deal with it on their own, right? I mean, it's just
absolutely.
It's less we have to deal with. That's why when everyone talks about the offshore voluntary disclosure, even now, I'm doing a ton of voluntary disclosure, domestic. It helps the government. It's to the benefit of the government. I mean, you're right. Well, they're not prosecuting. They can't prosecute everybody. They don't have the means to. So if you could get a handful to just fix it themselves, hallelujah. So
I did a lot of that work too, Eric. When we lost the OVDP, and now we're with the streamlined domestic and offshore, but that it's kind of like the situation I was describing when clients come to me, have worked with another ERC mill. You sort of walk somebody through the end result of a streamlined, onshore or offshore. A lot of times they're running from the hills. So a bona fide voluntary disclosure program, I'd certainly be an advocate of that.
Yeah, no, the biggest thing we're finding is we're doing a ton of, now that the IRS is gearing up and notices are going out, we're doing a lot of voluntary disclosures, domestic, just because people are like, well, they're leaving me alone, right? So I don't want to go. Now all of a sudden they're coming in to fix it. The biggest issue we have, which is always fascinating to me, I want to clean this up. I want to sleep at night. Wait. What do you mean I have to get rid of the undocumented workers? I don't want to get rid of my undocumented workers. Like, no, you got to stop committing the crime in order to do that. We're going to go to the government and lay all this out on the table. And we actually have had people saying, and I've learned this, you have to have this discussion up front. It used to be people would come in, we'd get that pre-clearance in because I want to get our foot in the door quickly before they are found. But now that knowing that people sometimes back out because they don't want to stop what they're doing, we sort of do a lot more vetting up front. So I don't go opening a can of worms for them, without it. But no, it's great time to be in representing taxpayers. There's so much opportunity here, from the credits to the programs to helping people deal with the fallout of it. Audits are going to go up, elections are going up. It's like part of your brain's going, oh, that's too bad. And the other part is like, cha-ching, cha-ching, the cash register noises, because it's just opportunity to help people.
It's not going away anytime soon. You're going to be hearing about this for, I agree with you, the next at least 3 to 5 years.
Yeah, no, that's the ERC, and then there'll be the next program, and there'll be the next. I mean, if you think about it, 09, you're right, offshore. We ended up with the streamline. They overhauled the domestic. You had PPP, ERC.
What's next?
It's always the next thing. It'll be the next thing. But all right, now, gentlemen, both of you, thank you for joining us. Everyone, thank you for listening. I'll put the links below down to Andrew. So if you want to get in touch with Andrew and look at the insurance for your clients, you can do that. I'm going to put the link down there, the EZ-ERC for both the practical guide, and you can get in touch with Ken if you think you can bring him in, help with client situation or just consult. And also the link for the 21st when we do the webinar. And again, look for an email on that.
And Eric, just a quick plug. We have created a dedicated page for TRN members to go through, which, basically means that I'll actually get those in my inbox too. So they'll sort of get the white glove treatment to the extent that they use the link that we've created for you and your members. Exactly. And that's the one I will put in the description. Both Andrew and Ken are terrific resources. If you have clients or can, think you can use them, highly recommend you reach out. And again, join us for the 21st. And gentlemen, thank you both for taking the time. This has been terrific. And we may end up doing another one because as this goes on, and we start to see audits are going to evolve. Appeals is going to start weighing in, like some of these gray areas. We're going to start getting decisions out of appeals, potentially tax court. It's going to be to those of us who are tax geeks. It's going to be fascinating to see where this goes. So maybe not so much for the clients, but for us. No, it'll be interesting to see when we have when will we have case law? When will we have rulings? Is it going to be too late? Sort of matching that up with the statute of limitations. So we'll kind of see. We're eyeballing that statute. It wouldn't surprise anybody in my world if the IRS does something or Congress does something similar to what they did with the PPP. It would make sense. Yeah. All right, gentlemen. Thank you, and thank everyone for listening. And go check out the links below. And otherwise, we will see you next week on the podcast. Thanks, Eric.
Great. Thanks so much, Eric. Thanks, Kenny.